Welcome to the Fear and Greed Daily Interview. I'm Michael Thompson. One of the biggest and probably most meaningful trends in investing in recent years has been the shift towards ethical investments. I'm talking about the decision by investors to put their money into companies and funds that align with their views on a range of issues, from climate change to modern slavery. We're now also seeing institutional investors like super funds taking a very definitive stance on the issue, using their influence to drive change at major companies. I wanted to look today at the broader shift towards ethical investing, what it means, how it works, and whether there's a trade-off in the financial returns. Karyn West is the founder and managing director of Apostle Funds Management. Karyn, welcome to Fear and Greed.
Thank you for having me.
Let's start with the basics. Is ethical investing a decision based on improving society, or is it a financial decision?
I think it's actually going to be both. I think historically it was about trying to do good for the environment and for society. But I think a lot of people now recognise the inherent danger in not taking the climate in particular into consideration when you're investing. I think if you're not really thinking about the impact of particularly fossil fuels and a number of things that we exclude when you're making investments, you're potentially putting your portfolio at risk. If you're investing in oil, for example, and you're not thinking about the renewable sector, you could be actually missing out on a really good source of return and sticking with something that's going to be, the dinosaur.
So assuming that a fair chunk of it is limiting exposure to risk in investments that might have some climate risk involved in them, does ethical investing mean that there is a compromise on the financial return?
No, I don't think so. Our back testing before we launch our product, looks at, are investors going to have to give up return to make this decision? And our back testing actually proves the opposite. You're actually making a better return by investing in ethical and impact investing than if you were just investing in a passive, we back tested against ASX, MSCI, more passive types of indices. And you can actually do better if you're investing ethically.
Okay, so the returns are either comparable or better than non-ethical investing. What's happened? Why has that change come about? Because previously there was always a perception that there was a compromise on the return if you were steering clear of some of the bigger, more profitable, but potentially not so ethical investments.
I think over the last couple of decades, the people who were making some of those decisions to invest more ethically were swimming against the tide. But I think that tide has well and truly changed. And I would say it's a combination of people now observing a changing climate. Australia in particular, I think most people here can feel the temperature rising. We've gone through droughts and fires. I think people are fairly convinced that climate change is real. And I think there's also been a government shift. Europe's been a leader in making carbon changes, and now we're seeing the US come on board. And over the last, I would say 3, 4, maybe 5 years, there's been a lot more opportunities to invest in clean or renewable areas that historically just really weren't viable. So now there's a huge array of particularly clean energy type of products to invest in. So there's renewables in terms of solar, wind farms, etc. There's a whole segment called green bonds, which is where the proceeds of the bonds are directed towards green projects only. So that's a new sector in the market that previously wasn't there. I think the opportunity set is now much, much broader, and there's a lot in the VC space, the venture capital space, private equity space. There's products like female leaders VC funds. We work with one of our managers that's trying to address the gender equality issue. And historically in venture capital, there's quite a small number of decision makers choosing which venture capital companies to invest in that are female. So there's a gender bias there to always be backing VC companies led by men. And now there's products that are trying to shift that bias and have the decision makers, mostly female, to look at potential products that would maybe be more appealing to the female market. An example might be Own the Runway, where you can rent dresses rather than buy them. These are, couture dresses. And some VC companies may have overlooked that because, if it's a guy running the VC fund, they might sort of think, well, is that really that interesting? To a woman, it might be much more interesting. So I think there's just so much more product available to invest in, and the opportunity set is now really ripe. I think that tide has changed, and I think people are ready to try to invest for good.
Stay with me, Karyn. We'll be back in a moment. My guest this morning is Karyn West, founder and managing director of Apostle Funds Management. We've looked at a little bit at climate risk and climate change. Putting that to one side, what are some of the other investments that people are now starting to move away from?
It's quite an array. We have quite a strict approach to this. So we call it zero tolerance investing in liquid markets. We are taking into consideration fossil fuels, so that's coal, oil, petroleum, etc., weapons and defence, gambling, alcohol and tobacco. Alcohol and tobacco and gambling have kind of always been on the radar for our institutional clients. So that's nothing new. It's just that we take a zero approach to that. Animal cruelty is another one. It might be a surprise. It's not just around live animal export. It's actually going down to fisheries, dairy. For some of the people that want to direct their money for good, they consider the dairy industry contentious. So we've excluded dairy. Deforestation, that's really around old growth logging and the production of new nuclear power facilities. So we take quite a broad look at that. The other areas that have quite a lot of deep dive and more of a qualitative lens applied to it is human rights violations and unethical corporate governance or unethical corporate behaviour. So that's more subjective and requires a very deep dive on any of those types of companies.
Yeah, I'm interested in that one because it does seem a lot of decisions could be made quite simply by looking at where revenue is derived from. So that if revenue is derived from, say, gambling or weapons, that's pretty much black and white. But then when you get into something like unethical corporate governance, there is really a lot of judgment required there. What would trigger a move away from a company looking at unethical corporate governance? What does that look like to you? And at what point do you make that decision to exclude it from your fund?
So there's no sort of easy answer. As you rightly pointed out, it's really subjective. So what you need on your team to make these calls are really experienced people. We have an advisory board with two very experienced ESG people, including a professor of finance whose specialty is in this space of unethical corporate governance. So we really need to have some expertise on the board that we can utilise to help guide us and understand the issues, because it's almost, company by company specific. In addition, we use a group called Sustainalytics that do a lot of the screening for us. So that helps us with rating companies on their level of corporate governance. And it goes into 6 bands. We choose the highest quality companies out of those couple of bands. And then in the case of Australia, you will also have to do a heavy qualitative overlay. So that's where we have a portfolio manager dedicated to the product who spends most of her time really just looking into these issues. An example might be after the Banking Royal Commission. You have to make a decision at some point when the news is turning very negative against the banking sector, and you can see that there's going to be outcomes that are very poor for stakeholders and participants in that banking sector review. You have to make a decision about the when. How bad is the problem? How long is it going to last? When do we come out? I mean, ideally, you don't really want to come out at the bottom and all the news is in the share price. So our portfolio manager has the discretion to be looking at the events as they unfold and making judgment calls, tapping into the sources that we have internally and also through the Sustainalytics materials that we have. So in the case of that, it would have been a number of incidents that came up through that Banking Royal Commission, and they really have done a number of things over a period of time. So it's picking the point to exclude them from the portfolio on our framework that we use to decide when somebody should be booted out of the portfolio. And then more importantly, it's an ongoing engagement with that company to understand what they're doing to rectify the problem. If it's a very big problem, you really need to see probably a change at the very top. A lot of these problems stem from the board and the CEO. So quite often when there's a very significant problem, you need to see a change at the top to reinvigorate that company. We would want to see any fines, etc., paid. We'd like to see the event behind us before we want to re-include it in the portfolio. So there's a lot of ongoing analysis into each one of these companies once they're excluded before they come back in.
We'll be back with more in a moment. I'm talking to Karyn West, founder and managing director of Apostle Funds Management. How far down the chain do you look? So say when you're looking at a company or an investment, how far into their activities do you look? Because in some cases, a company's primary revenue might be derived from something that would be considered to be an ethical investment. But if they then have an investment in another company that might be crossing that line into something, whether it's fossil fuels or animal cruelty or something, how do you go about following that chain and how far do you go down? Can you draw the line somewhere?
Well, we have to draw the line. Otherwise, it's really difficult to manage the portfolio. So what we have decided to do is look at all forms of revenue, whether they be direct or whether they be through owning subsidiary companies or other entities in the business. So we look across all revenues. But what we don't do is we don't go through the supply chain, because if we started doing all of the suppliers to every company, A, the job would really just be an enormous job, probably unmanageable, and B, there would probably not be enough to invest in, to be honest. It's difficult enough in the Australian market to do this well. After the Banking Royal Commission, there's been some issues with the banks, so there's an impaired sector there that's recovering. And the whole mining sector is fraught with danger for us. So we have to really pick the eyes out of that. Obviously, there's no coal. There's a lot of exclusions, and our market is very mining dominated. So if we start going through the supply chain, I think it would actually become uninvestable.
Do you think, though, that over time, as more people choose to make ethical investment decisions, that the pressure will become greater on these companies and that they may actually take care of some of these supply chain decisions for you?
Yeah, we're already seeing that happen. So there's been plenty of examples of groups divesting, for example, of their alcohol, because they realise that if you hold on to some of those investments, the underlying shareholders are not happy about those types of investments and it's going to impair them. So we're already seeing that happen. And we're seeing a lot of agitation by members of superannuation funds who, there's been a recent case where a member sued their super fund around not taking into account climate change in their portfolio, and won that case, or the case was settled. So I think it's happening from lots of different angles. I think there's a grassroots movement that's becoming very loud, and I think that is impacting on company decisions already.
Later this year, you are launching an ethical balanced fund. Can you give me the 30-second pitch for why this is where people should be putting their money?
Sure. So we're doing two things. We want to take a zero tolerance approach to investing broadly. And then in addition, we want to add in managers that invest for positive impact. So it's a case of doing no harm plus doing good for the planet. Those areas of positive impact could be companies that focus around poverty, hunger, health, education, gender equality, clean water and sanitation, etc. There's a number of United Nations Sustainable Development Goals that we are actively working to report on and work with. So our portfolio is balanced between Australian equities, global equities, impact investing, Australian fixed income, global fixed income, and then we also invest in renewables and other clean energy sources through ETF investing. And that ETF investing is really to balance our whole portfolio because the rest of the portfolio is underweight in energy. So our approach is to do no harm, provide really good returns to investors. And in fact, our historical back testing says you can get very good returns from doing it this way. We're not wanting to see huge deviations from index type of returns. We recalibrate the portfolio so that it's closer to broad market returns without having a lot of volatility around that. So I think you can get very good returns while doing good for the planet.
Karyn, thank you for talking to Fear and Greed.
Thanks, Michael.
That was Karyn West, founder and managing director of Apostle Funds Management. This is the Fear and Greed Daily Interview. Join Sean Aylmer every weekday morning for the full Fear and Greed podcast with all the business news you need to know. I'm Michael Thompson. Enjoy your day.